All right. Everybody, I got my buddy Nick on here. Man, Nick, I have been excited to get you on. I've been asking you to come on for a while, and our schedule's finally lined up. So thanks for popping on. What have you been up to, man?
Well, first off, before I get there, I just want to say it's great to see you, a dear friend. We've caught up at all kinds of different events. We've been able to travel together, different places. Somebody that out of thousands of people that I see a year at different events, and I know you do too.
Yeah.
You're one of the people that I just felt always in line with, and love to see your podcast and what you're putting together here. Great content, great topics. So
Yeah.
on our side, we have a crazy economy. I run an investment fund, you know this, but Saint Investment Group, we focus on only a small amount of investment niches on our side. Right now, we're heavily looking at fixed income as our focus on that side. So I'm doing that. We're great growth phase, great timing in the economy. And then other than that, man, because your podcast is focused on great things, I'm trying to hit the 1250 club for powerlifting. It's a big goal. I got 3 sons. I can't ever let them get stronger than me. I did about a decade of fighting in the past.
Yeah.
Now I'm focused on powerlifting, and
Nice.
it's been a really fun pursuit and goal on the backside.
That's awesome, man. Yeah, I'm always enjoying seeing your videos with your kids, and then you lifting and stuff. So that's awesome. You're a great dad.
Yeah, so it's been fun. We now that I got a bunch of kids, the focus is only on a couple things at a time. So
Yep.
hitting investments, hitting health, and then trying to give back. We're working with a few different philanthropy causes that we're spending more time.
Yeah, I saw that, man. That's awesome. And you know what? The one thing I wanted to talk about with you is your fund is a little bit different than a lot of my other guests that I've had on, because a lot of times the people I've had on are investors that have like syndication funds for real estate, right? Yours is a little bit more diversified. Can you kind of go into exactly like the type of investments that you're chasing? Because it's not strictly real estate.
100%. So the background is I'm a syndicator too. I come from a background where I was working mostly with JVs, mostly as acquisitions. My early background was working with a couple small family offices. So I had the benefit of being really classically trained on the acquisition side. So we started leaning in. We've done about 19 syndication deals, 7 full cycle. And then what we found, because we've always targeted, and we've talked about this, but we've always targeted at Saint, very high net worth, very sophisticated investors. What we found was that around, 5 years ago or so, the focus shifted. And we found that these guys were usually a little bit ahead of the curve. They were looking for fixed income. They wanted a set return. They felt that equity strategy investments were going to go through a rough patch, and they wanted to find something that projected out a decade, 2, 3 decades out. On our side, I bought a lot of mortgages historically. Usually it was just me buying them for my own portfolio. I loved the fixed income component. I loved that mortgages in the US are this rare thing globally. We have 30 years of fixed income, fixed rate, fixed payments. So we built a whole fund around that for our investors because they were asking for it. And so the Saint Income Fund today is, vast majority of that is based on mortgages backed by single family homes. So it's a little bit of a different model, still the real estate world, but I love the US economy over the long term. Sure, we have short-term blips, sure we have highs and lows and volatility, but long term, I'm so bullish on the US. And I find the best way to invest in that right now is the, 30, 40 trillion that we have of the US national wealth of the US citizens are tied up in single family homes. So how do we get to be a part of that?
Mm-hmm. So when you're investing in mortgages, you're basically like, let's run through a scenario. A homeowner is going to buy a home, goes to their local bank, goes to a broker, right? The bank or the broker will set up the loan, and then 95% of the time, they're selling those mortgages off, right? So Saint Investment is coming in and buying those mortgages off of the banks or the brokers, correct?
Sure. The only thing I'd add, so that's exactly right. The only step that I'd add is at the very end. There's one more step where someone stops paying on their mortgage. So we buy mortgages that are non-performing or underperforming. So, I'm a discount buyer. That's kind of my background, is buying things off market. And so we wait until there's a payment problem along the way. So the only step is, like, let's say that during COVID, for instance, somebody got furloughed, somebody got laid off, they missed 6 months of payments. and then they're not paying today. Well, on our side on Saint, we would look at the huge pool of mortgages, maybe hundreds at a time, contact the borrowers and say, hey, why aren't you paying? Why aren't you paying? And often it's, hey, I want to pay, but my mortgage is $3,000, but I can only afford $2,000. So on our side, it's, does it make sense to drop the payment, maybe extend the term of the mortgage for a period so that we offset our returns? And at the end of the day, we try to make a win-win-win where banks want to sell us their non-performing mortgages because they're amazing at originating, creating mortgages. They don't really like that whole foreclosure process or workout.
Right.
That's a lot of the time. So we kind of can carve out that niche. We can customize a loan package for the borrower in that case for a loan modification. And then we can get cash flow for a long period of time and keep the homeowners in the homes. That's our end goal.
So what do you what percentage do you think of the mortgages that you're investing in are actually going into foreclosure?
For us, we complete foreclosures couple percentage points, very small.
Wow, that's really good.
But we choose wisely. It's not our model. There are other groups that love the foreclosure process, and that is their literal business. We are the opposite. We're building an income fund. We want many, many decades of consistent returns behind that. So for us, because we choose so clearly, we have very clear buy box, et cetera. It's a much lower percentage than others, but there's other people that have great returns that focus on foreclosing. So for us, to answer your question, it's a very small sliver.
And so as an investor, what kind of returns are investors seeing with those kind of investments with into mortgages?
So we're pretty proud of our investment profile. The higher end of that is 12 to 14.28% returns. So,
Cash on cash or IRR?
IRR.
Okay.
Yes.
Okay.
Yeah, correct. It's so, because those are different models. Sometimes it's a cash flow model. Sometimes it's a compounding return model. So the investor gets to choose all those, different variables, but the net return 12 to 14.28% return. So good returns. It does not have any tax benefits. There are trade-offs to this, right?
Yeah.
But if you're just looking for a fixed income model, it's a great model and it's a great asset class to pair with someone looking for more of a fixed return.
Yeah, which is more of your. I mean, I guess if you've got the liquidity, right, and you want somewhere to park your cash rather than a money market account, I guess it could apply to any age demographic. But typically, you usually see those fixed income in the older population demographic, correct?
100%. And I think it's making a comeback with the younger generations, to be fair. But, especially we all went through a decade plus where bonds weren't that interesting, right? So fixed income and equity investments were killing it. Syndications were killing it. But still our bread and butter, the people we work with a lot today, business owners that want to offset cash flow and add a stream of income. Someone that might be selling a business that says, hey, I used to make a ton of money. Now I'm all cash. I need to do something with that and get a return. IRA investors, people that have lots of cash that's sitting. They don't want that 4-ish% the treasury. They don't want a high yield savings account. They want something that's still an investment. It's an investable asset class, but isn't, as much of the equity side, which right now a little rocky, some of the rocky, assets in it.
Tell me about it. And you know what? That's a really good point too, because I think a lot of financial advisors will tell their clients, hey, let's park some money in T-bills, right? Let's park some money in T-bills. Well, what's treasury at right now, right?
Yeah, 4-ish. But
yeah,
to your point, let's game theory that out. Let's play that out. Okay. Let's say it's 4.5, just to be generous. Let's just say it's 4.5, although it's been all over and it's been very volatile on its own. If you're at 4.5 and inflation prior to, the mix up with the tariffs, et cetera, and all the stuff, inflation was approaching 3%. Most people forget that pre-tariffs, we were dealing with increasing unemployment and we were dealing with increasing inflation. That's called stagflation. We're getting towards that. We were getting towards that. But let's just look at inflation. Inflation was creeping up to 3%. So inflation was at 3%. And you're investing at treasuries at 4.5%, your net return, you got 1.5% there. My guys aren't those guys. My guys are saying, hey, I'd rather get a slightly higher risk because it's not guaranteed by the federal government. To be clear, we're not the federal government, but so a slightly higher risk, but there's so much more meat on the bone that the risk profile that they view it from is that it's actually safer than a 1.5% net return. I'm not a treasury guy. I know you're not either, for those reasons on my side. So yeah,
Mhm.
just too slim. The margins are too slim.
Yeah. So to further explain for people, and correct me if I'm wrong, if you're averaging 12 to 14, let's call it 13% IRR. If you're investing in a T-bill at 4.5, you can invest with Nick and make 13. If inflation is 3, you're still 10 points ahead of the game rather than a point and a half with the T-bills, right?
Exactly. And that's the discussion we have with a lot of our highest end, most high net worth investors, is they just understand that there's a different premium on going private. And if you
Yep.
look at the stock market right now, you look at the fact that since 1995, the stock market, the number of companies in the stock market has reduced by over 40%. It's
Wow.
not the diversified asset class it once was 30 years ago. So now we're looking at private investments, what you do, what I do, as opportunities that oftentimes are starting to have higher returns, less risk than they had historically. And that's a bigger opportunity for investors today. So we see
Mhm.
a lot of people moving out of public markets and going to private. And I think that's a good trend with how insane a lot of things are on the stock market today.
Yeah, totally. Now, do you really buy the 3% inflation? Because I think there is, in my opinion, there's inflation that's told in the news, and then there's real inflation.
So that's a great question. And so you're smart enough to know that there's no perfect economic metrics out there. That's
Mhm,
one,
mhm,
right?
mhm.
And just to give a comparison again, the Federal Reserve's job is to maintain inflation, typically a target of 2%, and then maintain employment. Typically, they want unemployment roughly around the 4% range. What we
Mhm.
know, if we're looking at the other half of the variable, the unemployment, is that they revise it every freaking time. It's
Yeah,
always a revision, meaning
yeah,
they never actually get it 100% correct. So
yeah,
why would we ever think they could nail inflation down to 100% accuracy? We know that
right,
that's not the case. So
right.
then if you look at CPI, Consumer Price Index, which is what they use as the general term to use inflation, sometimes they use a different PCE. But let's take CPI for the case of
Mhm,
this.
mhm.
It doesn't include everything, and some things are weighted more than others with how they calculate this. So it's not a perfect variable of what we experience as consumers in our lives of what
Mhm.
inflation does. Now, we can have the discussion that maybe numbers are fully fudged,
Yeah,
right? And that's kind of
yeah,
the other half is like maybe they dumb those down because many government salaries, many government pensions are tied to inflation. So it's
mhm,
in the interest of the federal government to produce low numbers on that
mhm,
because
mhm,
increases for their government employees are less in that
mhm.
case. But this is what I'll tell you. This is what I'll tell you for certain. We know that since 2020, roughly, what was it, 80% of every US dollar was printed since 2020. We think
Correct.
the purchasing power of the dollar has gone down roughly 40% since 2020. So what we know for certain is we've gotten crushed as far as the power of our dollar as it exists today. We know
Yeah.
for certain that the cost to buy a home today is over, what is it, roughly 150, 100, some 100 plus percent, 100 to 150% more expensive in different, depending on the market, for consumers to buy a home today. We're not in a good place as far as purchasing power of consumers. So do I trust CPI as 100% accurate? Absolutely not. But I know that if you look at the other numbers, it often tells a much worse story. So
Mhm.
investing today and looking at the market holistically, especially with how we do as consumers, is more important than ever, especially when it is volatile as it is right now.
Oh, 100%. I mean, do you think that when the feds raise rates or anything like that, does that affect your business in any way? Or is it just, it doesn't matter where rates are at, you're still steady the course?
So that's a great question because what we know, we're equity investing or syndication investing. When you invest in one asset, it's a building, it has, whether it's multifamily or industrial or retail, we know that interest rates being lower boost the value of those properties. So it's,
Mhm.
it's the right question. What about debt? What about mortgages? What we found is actually almost counter cyclical, but we're good and comfortable in either environment. If rates go up, what we find is that less people refinance in our portfolio. So we
Mhm.
get more consistent payments for a longer period of time. So right now, it's an opportunity because we have actually more stable cash flow in the portfolio. If rates go down in inverse, what we find is that our portfolio refinances more and then we
Sure.
reinvest the proceeds on that. So it actually bolsters the portfolio with more assets. So I really
Mm.
like debt for that reason, is that mortgages backed by single family homes, which is such a tight supply on that time. There's not enough homes to go around. There's millions less homes than Americans need today.
Correct.
So I like those fundamentals. That if you look at the trends for the next 10 to 20 years, it looks like we're at 10 to 15 years of people not, or of builders not building enough homes for Americans. Now, I don't
Mhm.
love that because I'm pro America, I'm pro US, but I also know I want to invest where the opportunities are. And if we're investing into mortgages, if we're investing into single family, then we're investing into a situation where we can help people and provide good returns with the supply demand imbalance that we're seeing right now.
Gotcha. So, can you explain how, as an investor, if let's just say, let me just use scenario purposes. Let's say if rates are at 6%, right? If rates are at 6% and you're buying mortgages, how are you able to achieve a 12 to 14% IRR? Is it because you're buying the mortgages at a discount or what?
Yes, that's part of
Okay.
it. That's a big part of it. One, we buy roughly, I think our average discounts around 27%
Hmm.
of the mortgage amount, right? The unpaid value or unpaid balance is what we call it
Mhm.
in the mortgage industry. So we not only is it an unpaid balance discount, there's also things like legal fees that are added on. There's also things like if you extend the length of the mortgage, which we very commonly
Uh,
do, it actually extends the amount of period of time of those payments. Also, it resets the amortization schedule. I'm getting a little bit into inside baseball, but
yep.
all those things combined yield us, high teens, low 20s returns. So we can give
Mm.
investors that 12 to 14%, 14.28% with confidence and, feel good about that and still have a margin of error there.
How, how do you even get in the network to even get into buying mortgages? Are you just networking with servicers or originators and whatnot?
So it's a little bit of everything, but you hit the nail on the head that one of the blind spots. So classic real estate, you buy a building, it's easy. You go on CoStar, you can go find a million of them, right?
Right,
You might
right.
not like the pricing that's out there in the
Hmm.
market today, but
Hmm.
the access to inventory is a lot easier. The mortgage market is the complete opposite. There's no
Mm.
database to go into and go buy these mortgages. It's a relationship industry. There's a lot of trust. And you have to think about it from the main banks. Think about Bank of America. Think about Wells Fargo. When they originate mortgages, when they create mortgages or refinances for homeowners, what they're dealing with is a scenario where if they sell that mortgage off and it's non-performing, and someone goes and forecloses on a veteran or a grandma or some situation where it's this really just terrible situation, and someone's not being a good operator and they're not giving them the opportunity to, stay in the home, that actually reflects oftentimes on Bank of America because that's a bigger headline than some unknown company, treating
Right.
one poorly. So the reputational risk is what we call it, is so much higher for these big banks. They typically only work with really trusted buyers, and we're trying to be on that side of it. I bought foreclosures for many years. That's how my acquisition side was built out with these small family offices. So we have a reputation that's very positive. They know that we have a good, wallet and that we buy and that we're easy buyers and we ask the right questions. We move through due diligence quickly. We give yeses and nos that are confident. So
Mhm.
it's easier to work with us. Getting access to these mortgages, to this inventory, is a huge difficulty for new operators in the space, to your point.
I think that's a huge point that is super important if you're looking to get into really any realm of business, but especially in the real estate, is those confident yes and no's. Because when you're working with brokers, when you're working with banks, when you're working with institutional funds, and they want to know, they want to have the confidence that you're going to be able to execute on not only the plan, but the closing, all of that stuff. If you get to the 11th hour and you're closing next week and all of a sudden the deal falls apart, you have ruined, I wouldn't say ruined, but you have damaged that relationship, right? Relationships are key in this business.
And in retrades, right? To your point,
Mhm.
just the other way of saying exactly what you just said. With people one yard line you and hit you with new changes or
Yeah.
new things that they'd like to add in the deal, it erodes the trust so much. To your point, that no one wants to work together.
Yep.
It can literally kill the deal. So on our side, our due diligence is down. We know what we're doing. We're confident with how we invest. We're confident with our yield hurdles, what the returns that we need to produce in order to get our investors access to the returns that we have, et cetera. So when people work with us, we're telling them out of the gate, hey, we're trying to achieve this. What are you guys trying to achieve? Oh, that doesn't line up. Well, we're going to give you a confident no, a respectful, confident no, that we don't really want to spend the time on underwriting and going through this whole due diligence because we just don't line up at the base level of what we all need to achieve here. And oftentimes they'll come back to the table and say, whoa. Maybe there's something there, right? Maybe there isn't. And so we found that in this market where we're at today, that if you just be respectful and you speak clearly and you hold your cards a little less close to the chest, that
Mhm.
people can compare notes more quickly and get deals done or not done, but you do it quickly either way.
Yeah, I think that's very important advice. All right, so if Nick was in charge of the Federal Reserve, what would you do with rates right now?
Oh my gosh, that's a big question. I wouldn't fight with Trump because he'd want to take my job away. That's for sure. Because he wants to fire Jay Powell really badly. Uh,
Yes, he does.
and he hired Jerome previously. So it's a funny full circle. This is what I'd say. I'd say that the Federal Reserve has. I'd say that the history of the Federal Reserve in the last handful of years, they fudged a lot with us. We know that to be a fact. We know when they said inflation is transitory in
Mhm.
2021,
Mhm.
that
Yep.
18 months later, inflation hit 9.1%.
Mhm.
That's not transitory. 5
Right.
years later, we're still dealing with inflation that was hiking up.
Yep.
Okay.
Yep.
That's not transitory. Transitory is short term blip on the radar type stuff. So they weren't honest about that. We know
Yep.
that the Federal Reserve has um, been they've been behind the ball too many times in the last 5 years, especially the post COVID world. They have done rate cuts at weird times. They indicated that they wanted to do something and then not done it. So they've kind of retraded us on multiple points. If I was
Mhm.
the head of the Federal Reserve today, honestly, and Trump wouldn't like this answer, but I'd hold steady.
Mhm.
Why? Because with everything that's going on with tariffs, and I'm mostly a laissez-faire capitalist, truthfully. I'm mostly hands off the market kind of guy. And now that we're digging into tariffs, and we're seeing this as a big discussion nationally, I agree with a lot of it. So it's a big shift for me too. But with
Mhm.
so many things happening at one time, I wouldn't touch rates right now. I like them to go down. And yet we really saw unemployment spike dramatically. I would be dropping rates. That's what I
Mhm.
would be looking at as Jerome Powell and the Federal Reserve chairs. I would be looking at or committee, excuse me. I'd be looking at dropping rates and keeping a close eye on unemployment as the number one metric right now. Because if that spikes, I think they need some rate cuts that will benefit real estate, that will stimulate the economy in big ways. And then with all this tariff talk that goes along with the rates and inflation, because the point of raising tariffs, if we strip back all the political rhetoric on both sides, is to bring manufacturing back to the US, number one, and to make the world trade scale for the US more balanced. Right.
Mhm.
So
Yep.
we get either one of those, then I think it's very safe to say that I'd be lowering rates. I'd be producing rate cuts as the Federal Reserve chair if unemployment was spiking in order to stimulate the economy, get manufacturing back to the U.S., and to give the consumers and businesses some breathing room while we sort through the tariff negotiations with all these other countries.
So I want to circle back to the tariffs discussion, but to further expand on the rates, how long do you think that you would have to hold rates in order for the economy to inflation to kind of settle?
I'll give you two answers. I'll give you both answers, both sides of the coin. Pre-tariffs, I saw rates being high for a decade.
Really?
I truly did because of the inflationary pressures. If you look at the 70s and 80s,
Yep.
remember, we just talked about this. We printed 80% of every US dollar in history in the last handful of years. Okay. The last time we had that degree of printing and dealing with that degree of inflation we had stagflation for a freaking, what was it, like a decade, right? It wasn't until Paul Volcker came in and raised rates to 20% that we slowed down inflation. So I saw rates staying right about where they are for probably the next decade, which if you look at the last 100 or so years is actually in line. That's about average.
We were spoiled in the early 2000s and whatnot.
So spoiled. And we had low rates. We had so much, the baby boomers with their 75 trillion in wealth investing, trying to, get into more things. So there's so much capital in the markets, et cetera. We had quantitative easing. We had all these multiple layers of support on the capital markets, basically giving us cheap money. So before tariffs, before Trump, I would have said we had a decade or so of high rates ahead. And I thought that was the Federal Reserve basically trying to get away or to avoid stagflation and get out ahead of inflation rising dramatically with all the money they printed. So there's something that a problem that they created, but we'll talk, we can talk about it some, that at a different time. But today with tariffs, I would say two things. The first is it's extremely difficult to tell exactly where this goes and what timelines, but I think they need to keep rates high until unemployment spikes and until we see a boom in true US GDP, which to me, when you fire 200,000, 300,000 government employees, that's painful in the short term. But those employees, if the government does it right and the economy sorts through, which I believe it will, they become private sector employees.
Sure.
It's true GDP growth. That means our economy actually got much stronger because government employees that were paid with tax dollars are now producing value to the US economy. Instead of taking tax dollars, they're creating wealth for the US economy. So 100%. I think we have, and again, I'm more of an optimist. I think we have probably 2 years of sorting through a lot of that, maybe 1 year of a little bit of pain, but probably 2 years of really seeing where this goes. And I think if unemployment spikes consistently, then a rate cut in the next year or so is very much that we'll start rate cuts. I believe that.
So do you agree with Trump's stance with the tariffs?
I'll say this, and I'll answer directly. But before that, I'll say I don't talk politics too much. I'm pretty centrist. I lean to the right because I'm an economic voter. So whatever's best for the American people that puts money in their pocket, it gets their eggs purchased, they get gas in their car. That's what I vote for. That's what I vote for every single election. Sometimes that's left, sometimes that's right. Lately, it's been more to the right. So that's just my bias.
I got you.
On the Trump side, as far as tariffs go, I am so pro-U.S. manufacturing. I am so protecting and bringing jobs and value to the U.S. that the tariffs initially, I said, this is a nightmare. Tariffs, it slows down the economy. All tariffs are a tax. To simplify it for the audience, tariffs are a tax. So my brothers and sisters on the left previously were saying, raise taxes, raise taxes, raise taxes. We need to pay for all these things that we're doing. We need to boost, income to the federal government. But now my brothers and sisters on the left are very anti-tariffs. I'm like, you got your tax. This is not the way you wanted it, right?
Right.
So I would say this on tariffs. Let's look at what actually has happened so far, okay? We've seen the biggest influx of interest to bring manufacturing to the U.S. that we've seen in decades. Honda, Hyundai. We've seen Taiwan Semiconductors in Phoenix. We've seen Apple Computers commit to $500 billion over the next decade. The list goes on and on and on and on. So to bring manufacturing back to the U.S., I think it's painful for the stock market. That's a short-term situation. But I think it's very positive as we're seeing manufacturing being brought back to the U.S. And then if you look at global trade, right? Trump institutes the tariffs. Immediately, everybody's freaking out. Stock market's crashing 10%. We're looking at plus or minus. But something interesting happened. Huge amounts of countries have stepped up and said, we're willing to have a conversation about lowering U.S. tariffs if you lower ours. So now we have Vietnam, we have Japan, we have Taiwan, we have the whole EU that came out day one and said, we're willing to do zero tariffs here, right? We'll open that discussion. We'll start the discussion there, right? Trump has taken a lot of heat. Sometimes He presents things in a way that feels more ego driven,
Yep.
sometimes presents things in a way that's more aggressive and muscle than it is finesse and mutual benefit. So
Mhm.
I don't think he presents things perfectly a lot of the times. But if you back up to Trump's first term, NAFTA, the North American Free Trade Agreement, we were getting hosed. We had bad terms on that. Trump renegotiated that. We heard the
Mhm.
same things. We heard we're treating our allies poorly. We're positioning ourselves away from the rest of the world. We're breaking down global trade. What happened? He renegotiated. He renegotiated NAFTA too, and then
Mhm.
Biden came into office. Trump's stupid. He's terrible. He hates everybody. He's the worst. And they go, oh, you're going to roll back NAFTA too. And he's like, whoa, 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 I'm not rolling back NAFTA too. We're keeping NAFTA.
Right.
So you're going, wait a second. If Trump's so bad, why would you keep NAFTA too?
Yep.
Largely considered the crown jewel of the Trump presidency term one. So now we fast forward to term two to answer your question directly. I was pretty against tariffs, but I believe the proof's in the pudding, and the amount of time I spent on economics, I want to look at the data. And right
Yep.
now, the data is very positive. I believe that we're bringing manufacturing back to the US, and we're setting the stage for Trump's to work through with other countries to bring down tariffs of US goods nationally. So if we're making more at home and we're sending more globally out to the world with lower tariffs, I think that leaves the US in a great, better state than it was when he entered office. So all the things aside of how he does things and how he presents things, if we achieve those two things, I'm a huge fan of tariffs.
The ironic thing is that if you go back, again, I'm like you, I'm a centrist, right? I think politically wise, like I'm not one party because to me, both sides they're idiots, right? They do themselves wrong by just this banter back and forth, right? Um, but if you go back and you look at videos of Obama and Pelosi, they were saying the same exact thing that Trump is saying right now. Pelosi said it in the early 2000s. Obama said it in his first term, not only about tariffs, but also about immigration as well. And now I 100% agree with you. The way that Trump conveys his message, so ego driven, it turns everybody off. But if you look at the other side, at other people on the other party, they were saying the same exact thing, right? And on top of that, I think there was something a little misleading about his, and I want you to correct me if I'm wrong on this, but that chart that he put up of the trade imbalances between countries, or the tariff imbalances, that was not a true tariff percentage. It was actually tariff plus trade imbalance, and those percentages had to be put in place in order for the balance to occur between, say, U.S. and China or U.S. and the EU and all of that stuff, right?
100%. So let me you hit the nail on the head. And let me agree with you and kind of give you a broader perspective of what we dug into on our side with our economic study of it. To me, the biggest issue with that chart where he said, here's the tariffs we're assessing to everybody, it was that they just didn't come out and say the fact that it also included trade imbalances.
Mm-hmm.
Because if they did, I think it's more palatable and it shoots straighter, right?
Mm-hmm.
I
Mm-hmm.
want government to shoot straight with us. So that's that side. But if you look at the other side of that, the reality is, if you just look at the history, most countries have screwed us and we haven't enforced our trade agreements with them to a high degree. I mean, if you look at, I think China, the most obvious example are soybeans. They said they'd take X amount of soybeans, and then they couldn't take any, right? Huge amount they agreed to as part of a trade agreement, and we just never enforced it. So if you look at international trade from the U.S. perspective, which for
Mm-hmm.
some reason people don't want to do, they feel like that's mean to everybody else. But every other country is trying to give their citizens, their production, their manufacturing, their trade an advantage. They want to be treated fairly. So on our side, to include trade imbalance into the
Mm-hmm.
equation, I don't disagree with that at all, because
Mm-hmm.
we have a long history in the US of letting other countries play unfairly against us, and we just write it off, right? And so, oh, by the way, not only do we write it off, we also protect every ocean in the world. We also invest in the whole world's security,
Yep.
back up global trade. So
Right.
all that to be said, I don't think it's unfair at all for us to have a calculation of not just what they assess tariffs to us, but also the trade amounts. If they want to be closer friends, buy more shit. I don't know how
Yeah.
to be nice. You know what I mean? Like,
Right.
you want to work with us, then work with us, right?
Mhm,
Don't put
mhm.
tariffs on us to the degree that we don't do to you, and buy more of our stuff if we're buying a lot of your stuff. So
Yeah.
I agree with that approach. I just wish they shot straighter and just told us that exact thing that you said, that it was that was the calculation.
Do you worry at all about some of this foreign investment? As an example, I believe it was Saudi Arabia committed to $1 trillion over 10 years investment into the U.S. Do you worry about that kind of foreign investment into the U.S.?
It would be a case by case basis, but this is what I'd say. Foreign interests investing into the US get complicated when you start overlaying lobbying, because
Hmm.
then we're not having true politics. We're not having true discussions that benefit Americans.
Hmm.
Investment into the US gets complex when they invest in things that are very close to things like national security, right?
Hmm.
Like,
Hmm.
investment into the US does not scare me if they're investing into industry. So if they're like, let's say China woke up and they wanted to invest in manufacturing in the US. We see them investing very heavily in south of the border, right? Why? Because they want to skirt the system. They want to take Chinese goods, they want to import it to Mexico and take the
Hmm.
lower tariffs there and then move it to US soil. So they want to skirt that. And it's very clear, it's very obvious there. That's just a super obvious example. If they were to like, if let's see, if Iran wanted to invest in nuclear power in the US, I'd have a huge issue. My eyebrows all the way raised, right?
Yeah.
But as
Yeah.
far as them investing into, like, let's say Honda and Hyundai
Hmm.
investing into US manufacturing plants, I love it. I think it's fantastic. And I frankly think we've invested enough in other countries, giving them incentives to move manufacturing back to the US, I think is a net positive, as long as it doesn't touch national security or it just doesn't become an issue where they're skirting the system in a major way. If they're playing by our rules, then I think that's really the point. I'm a huge supporter of that.
Yeah. That makes complete sense. I want to go back to what you said about bringing manufacturing back to the U.S. I too also think that's important, but I wanted your opinion. I feel like, I think everyone could agree that the middle class has eroded over the last 50 years. And a lot of that is because of these corporations taking their manufacturing overseas. One would even argue that NAFTA was a huge fault of that, allowing these corporations to move to Mexico for the. I mean, look at Roger and Me, the movie Roger and Me. It explained that perfectly. Do you think that the American culture now, especially with the younger generation, is able to still do manufacturing? Because you're talking about, I'll use a prime example right here in my area. Right, I'm right outside of Chicago, where there's a lot of refinery and steel mills along our lakefront. The one steel mill, there's four major steel mills. The one steel mill that at one point was the largest steel mill in the US, I believe, had 30,000 employees in that one mill. And technology has improved, which has reduced that workforce. But a lot of those jobs left because now they're manufacturing that steel elsewhere, cheaper. So to try and bring those jobs back, I don't know if the American culture, the younger generation, is capable of that kind of hard, gritty, laborious work. What's your opinion?
I started in construction building walls, so I might be the wrong guy to know. But this is my honest to God opinion. I think the middle class is absolutely eroded. I think there's been an attack on the middle class. And let me agree with you even more. Maybe I have even more extreme of an opinion on this than what you laid out there. I think one of the biggest risks that we have as a country is the fact that we've allowed so much manufacturing go overseas and we have stopped majoring and giving higher level education to manufacturing processes. If you looked at the
Mm,
breakdown of college degrees, we see things that are low ROI, meaning
yes.
sometimes negative ROI, as huge swaths of the college education sphere today.
Mm-hmm.
That is not what college is designed for.
Yep.
College is not supposed to be, you riddle these kids with a whole bunch of debt for a lifetime, and the
Yep.
ROI on their degree is net negative. That is not a benefit to society.
Don't
Okay.
get me started on colleges.
So I could talk all day on that. But here's if we drill down on college degrees, here's where we've lost focus is manufacturing processes, manufacturing robotics, manufacturing engineering, right? What we're
Mhm,
seeing that I'm very optimistic about is that the trades in the United States have been booming, right?
mhm.
Have been
Yep.
booming. When I was more or less a day laborer building walls, and my background was in masonry, not
Mhm,
masonry where we dealt with stonework and marble. We
mhm,
keystone retaining wall. Okay.
mhm,
So
mhm,
this was not glamorous by any means, and it didn't pay well. Okay. It was the only job I could get as a young teen. But that said, do I think that it's a miss for us to not have that? Yes. Do I think it's coming back? I think also yes. I think the trades, electricians, plumbers being paid much more is going to pull focus away from low ROI college degrees and put kids, because humans aren't stupid, right?
mhm,
We
mhm,
it's the right system. And our electricians making 3x what a starting lawyer is, which is kind of the case right now, that
mhm.
they're going to go to where the money is, where the opportunity is. And that's how it should be. We shouldn't be subsidizing low ROI activities. Now, the second question you had was, do I think the American, populace today has a huge interest in labor heavy work? I mean, I would say no. I think that's a dark answer to give, but I think no is the answer to that. But I
Mhm.
also think there's ways to create that environment. One, it's that the natural system shakes out in a way where it creates jobs and the most of the jobs are towards that sphere. Two, I think robotics and AI replace a huge component of the turning the lug nut on the tire in the in the Ford facility, right? Like
Yep,
there's
yep.
a huge amount of that's going to be automated and improved. So then what's next generation of manufacturing look like? Maybe that's more AI technicians and more engineers that are
Mhm,
creating those manufacturing back end so that, robots and, robotics steps in more, AI steps in more to produce that. My family was our background's in Detroit. I have a huge amount of family in the auto industry historically that still live
mhm,
those pensions that were the backbone of the country, right? That middle
mhm.
class hard work. So I think we're in a good place to bring manufacturing back. That doesn't worry me, but to fill in that gap, to your point, I'm also super pro immigration. Okay.
Mm,
So
mm.
two of my lefty stances is that I'm very pro immigration. And I think that there's low to mid skilled labor that we can be working with a lot of countries to bring in a set organized system. Not
Mhm.
everyone comes over the border. We don't have any idea what's going on. There's bad people coming over also. I'm not for that system. I'm for
Sure.
this where we say there are other people that want to step in, fill in gaps in our labor in the US. And I think those people should have an opportunity. So between robotics, between AI, between improving college degrees, higher level college degrees on more high ROI focus, and then improving the immigration policies in the US, we're there.
Yeah, yeah.
World War II, we went from being not the manufacturing superhouse of the world, a lower level power in the manufacturing world, to being the manufacturing powerhouse in 18 months, right? So do I think we could do that in the next 3.5 years? 100%, especially with the fact that the world is led by the US in AI, led by us in robotics. And if we put all that together, I think we have the recipe staring at us.
Plus, if you couple that with what you said earlier, if the government shrinks and gets rid of some of the employees, which, mind you, the largest employer in the United States is the United States government, which is not, that's not how it should be. That's not how our founding fathers wanted it either. And I think you're right. If you could trim the fat, as they say, in the government and be able to bring those people that were laid off into the private sector handling some of these technical manufacturing type jobs, I mean, it could shift our economy drastically and very quickly.
Absolutely. And I think exactly what you just said. Faster than we think, faster than we expect, faster than we have budgeted or expected at this point. I
Yeah.
agree with you.
I was actually having a conversation with a friend of mine recently, and I think another change that needs to happen, and I like your opinion as well, is the tax code, because here's a guy that's in the trades, right? Most of the people in the trades in my area here, they're making, at least $100,000 a year. If they're working overtime, they could easily be at 150. But if they're making 150, they're giving 40% of their income away to the government. So those are the people that are spending money, is the middle class, right? Now, I will argue the other side as well, because I know that on the left, they're big on, let's tax the rich, let's tax the rich. Mind you, I believe the stat is somewhere around 65% of the total tax revenue comes from the 1%. That's huge. So, and those same people, the 1%, are the ones that are making the investments to try and grow the economy to bring more jobs to the US, right? So, where is that balance where the guy that's making $150,000 a year, which is good money, right, is not getting taxed to death, where he's not able to spend money to go out and buy these things? Maybe they want to upgrade their home. Maybe they want to buy a new car. Maybe they want to put new appliances into their home, right? And then on the vice versa, how do you fairly tax the wealthy to still allow them to reinvest in the US?
Those are the big questions.
Yeah.
So let's talk middle class. Let's talk average Americans for a second, right? The majority of the population.
Mm-hmm.
Here's the sad stat that we're at today. The highest expense for the average American today is now taxes. It's not cost of living. It's not, food. It's taxes are the number one expense item for the average American. That's insane. The fact that our founding, and again, I love the country, so I'll go back to the founding fathers. We revolted over a 2% tax, Bo, right?
Yeah.
We were throwing tea into the freaking, rivers over 2% here. We were pissed off, right?
Yep.
So we have departed very much from that. I never agree with the fact that taxes should be the highest concern of a budget for a family. That's terrible. I have a lot of kids, and that's, that's a scary stat. The other side is, let's talk tax the rich. Let's go to the other end of the spectrum. Tax the rich. If you stole, don't forget about taxation. If you stole every billionaire's dollar, 100% of their net worth in the United States, 100%, you took every dollar, that would pay for the U.S. government for 7 months. Where's the sustainability in that, right? Like that at some point our government's overweighted, if that's the case, right? Yep. We're talking about the fact that today we have 36 trillion in national debt. We're talking about the fact today that we add 2 trillion per year to national debt on average.
Crazy.
We talked today about how we have 1 trillion added per year in just interest expense on the amount of debt that we have in our government. So we don't have the issues of having a strong economy. We have a $30 trillion economy a year. That's powerful. We have an educated populace. The American people are educated today. And I think our country's stronger than ever at its core, at its roots. The problem is we've had this severe mismanagement of the money for so long. Okay. And I'll even beat up my friends on the right now and say that many presidents on the right have done this thing where they said, we're going to lower taxes, but then we're going to spend more. That the right is guilty of that at multiple stages with multiple presidents.
For sure.
No matter right versus left, where we're at today is we need to figure out our balanced budget. We need to get back to that place. It's a really hard discussion of where we make those cuts. You're right. I agree with what you said, that we have too many damn employees on the government side, right? So if we cut those employees and we move them to the private sector, then we have a true GDP growth. We have a true economy growth. Also, we have the highest amount of compliance in every industry that we've ever had. You know this, you and I feel this all the time, but every industry is going through that. Biden added something like tens of millions of hours of compliance into our economy for each business to manage and to go through and to pay for. And that doesn't add to their top line or bottom line or taxable revenue. That just goes to these ancillary, attorneys and compliance professionals that are not directly producing goods and services for our economy.
Yep.
If we speed all that up and we just go to the very end, what do I think we should do? I think we need to get back in line with balancing a budget. I think we need to make the government more efficient, AKA that means cutting jobs. That's a process, but I think that's the right way. And at the end of the day, that keeps breathing room to the rest of the economy in a big way. And it lets us focus on creating the value.
Yeah.
So that's kind of my take on producing real growth, producing real, a flourishing environment for the US right now.
Which I believe the last time we had a true balanced budget was Clinton, and he is the one of the most recent presidents that had the highest government job cut in his presidency. I think it was 400,000 government jobs that he cut.
More than Trump.
All while he was getting ahead in the Oval Office.
Yeah, he had some off-duty activities that maybe calmed him down a little bit for better.
Yeah.
But and I think that's a huge testament to where the politics was at that time. The right and the left could agree on things. And today, even when Trump's producing NAFTA 2 in his first term, and Biden eventually agrees with it, or we look at Trump talking about tariffs today, and Pelosi and others were agreeing with that in the past, we still vilify that. That's a problem. That's right versus left. That does not improve the country. That takes us backwards. So where do I think? I think we need to improve the tax code. I think we need to be not taking money out of America's families' pockets, where it's the highest budget item that they now have to create. I think that we created a tax code that benefits strategic investing in a huge way. We're beneficiaries of that, right? But that's what that is the government trying to direct where dollars are going, and then we all complain about it after the fact. So simplify the tax code, give the middle class a fighting chance, and if you don't like billionaires taking tax cuts and taking tax advantages, then remove those, right? Like, it's as simple as that. At the end of the day, is they're smart. Billionaires are smart. They're sophisticated. They have the best staff to do this, to eliminate the tax track. So if we don't like those policies, then we can always scale those back. But let's not complain about people playing by the rules.
Right. No, I agree 100%, man. And, for every law that they put in place to stop somebody from doing something, they're going to find a way around it. It's just kind of like gun laws, right? If you compare here in my area, Illinois versus Indiana, Illinois has, you can't carry a gun. Indiana can, but yet Illinois has the highest, Chicago has the highest murder rate in the U.S. They're going to find a way to find a gun, just like how the billionaires are going to find a way to skirt the system.
So then what happens? It's that the citizens that are obeying the rule don't have a gun, and now they can't protect themselves. Don't even get me started on gun laws. I live in California, right? So it's like you can't carry a rubber band gun over here. But that said, I'm a 30-year hunter, right? I've been hunting my whole life. I'm very comfortable around guns and have a high respect for gun laws and wanting those to be in place. But I'm never okay with a situation where the bad guys have guns and the good guys don't. Look at Brazil, right? People almost revolted over saying, hey, every bad guy has a freaking machine gun, and we can't carry even, basic weapons to protect ourselves. Right. Are going in the UK right now, where they're now talking about peeling back knife laws.
Oh,
can't carry a freaking knife in the UK. In many instances, they have specific laws on that, and they have all kinds of crime and all kinds of issues on that. So at some point, my goal always when I'm looking at economics is to benefit the most people and to the U.S. citizens. And so at some point, I think, self-defense is a very important discussion now.
Yeah, I agree. I mean, I just recently bought a gun, and, everyone I think that there's this mentality that you could just walk into the grocery store, or you can walk into Walmart and buy a gun. Just grab it off the shelf, go to the checkout, done, right? No, like I had to hand in my ID, had to go through a background check, blah, 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 all of those things, right? Most states that have gun laws have that in place, right? It's the ones where they're going out to the street and buying them is how they skirt that stuff. So, when you have, God, we could get into a rabbit hole, right, Nick?
Totally. I do go all day on that.
I know. So what's next, man? Where are you trying to go from here with Sane Investment and everything else?
So I'm just, my time is widely, is very focused right now. And it's really only three things. It's health, it's wealth, and it's legacy. So on the health side, over the next period of time, it's really focusing on getting my butt in the gym, lifting heavy weights. I'm trying to hit that 1,250 pound club right now. Nice. So I'm trying to get my 300-pound bench, my 400-pound squat, my 500-pound deadlift, roughly, to get to those numbers. And then, I was a fighter for many years. I know you're a jiu-jitsu guy, Bo. You probably kick my ass, but I'm getting my kids in jiu-jitsu, right? I want to
Perfect.
make sure that they're tough kids. They don't have the head trauma that I had from boxing for so many years.
Yeah.
I'm sure people could tell just listening to me, but and then the wealth side. The wealth side right now, it's such a crazy market that we're in. There's so many things moving on the US side. We want to be investing in what the economics is telling us, what the economics are showing us. And what we see on that side, our top 3 focuses moving forward, what we think are the best 3 investment opportunities over the next decade. Number 1, we like mortgages. Our fixed income, or the same income fund has a ton of interest. We're leaning into that very heavily. Number 2, industrial real estate. My background's industrial real estate. That's been our darling in the safe world for the last 10 years or so. So we've done a lot of those deals. We see a lot of opportunity on that side between manufacturing and distribution. So we're leaning in heavily there. And then the third, multifamily is taking a beating right now. A lot of people are dogpiling multifamily, but the fundamentals are so strong if you look at it, right?
Yep.
You look at multifamily, for the first time in US history, it's cheaper to be renting than it is to be buying a home.
That's crazy.
That's a huge bolster. We saw that multifamily was, even if there were some stumbling blocks, multifamily absorbed so much inventory over the last couple of years and still did pretty well. So all that to be said, I think multifamily over the next decade is going to be very strong. We see construction starts slowing down, which means it's going to be less supply on the market, meaning that it's better to be owning that asset class because the demand's going to be higher. And then on the legacy side, the last piece that I focus on pretty much every day is pouring into my family, getting time with my kids, making sure that the family side's tight, that they have the resources and things that they need to be learning and growing and being great. And then philanthropy, one metric that I want to point out is how philanthropic, how charitable the US is. We blow other countries out of the water. So as much as it's right versus left and good versus bad and everybody's greedy or a bunch of capitalists, that's not what the numbers show. The numbers show that we support causes more than anywhere else in the world, per capita, per person, of donations, etc. So I'm giving a lot of money to my church right now. I'm giving a lot of money to things like cancer research. I'm trying to put money that direction, trying to put focus. A huge focus of mine is to donate to entrepreneurial causes, things give Americans the tools that they need to be starting businesses, running businesses. And I don't know how to support this cause, but this is a newer cause for me, is giving Americans the tools they need for the next generation of business. I'm looking for those opportunities because with government employees losing their jobs at a huge amount that are being repurposed to the private sector, with the world changing in a big way, I think we have a lot of people where their jobs are going to be less in demand and there's going to be more opportunity for different job sectors. So trying to find ways to give back to education, to get people into the workforce for the next generation of work right now, for whether it's AI tech, engineering tech, manufacturing, et cetera. I want to figure out how to give back there. That's kind of a goal this year, is to figure that out.
That's awesome, man. I love it. I love what you're doing. I love you, man. You're awesome. Where can everybody find you at?
The best way I can give back is if they check out saintinvestment.com/resources. All these economic discussions, I obsess over them. I want to know the data. I want to know the numbers. So we do 1-2 hour webinars on economic topics monthly. So if they want to see all those for free or check out a live webinar, they can check those out at saintinvestment.com/resources.
That's awesome, man. Dude, thanks so much for coming on. I know you're a busy guy. It was hard to connect, but I so appreciate you making time for me.
Well, I had a blast, man. It's always good to connect. I hope to see you soon. And then, let's get together for another show soon, huh?
Let's do it, man. We got to. Thanks, buddy.
All right. Good talking with you, man.